Welcome to Casa Academy Chapter 13, Part 1, where we will cover types of mortgages and sources of financing. I'm absolutely thrilled to guide you through this material today because we are getting into the actual nitty-gritty mechanics of how real estate transactions come to life. Okay, so let's just dive right in. You're here because you want to totally master this material, right? Financing is literally the backbone of the real estate market. Understanding exactly how mortgage loans work is absolutely essential. And not just for passing your licensing exam, but for crushing it in your future real estate career. You're going to be dealing with these concepts every single day out there in the field, helping clients navigate what is probably one of the biggest financial decisions of their entire lives. Here's our roadmap for today's explainer. We're going to cover types of mortgage loans, repayment and amortization, monetary policy, primary and secondary markets, and finally, federal mortgage laws. Let's start with Section 1, types of mortgage loans, government versus conventional. When we look at government loans, there is a super vital distinction in the wording. FHA loans, which fall under the Department of Housing and Urban Development, they don't actually lend the money directly. Instead, the FHA insures loans made by approved lenders. This makes qualifying a whole lot easier, though you do still need a down payment. VA loans, on the flip side, are for qualified veterans and eligible service members. And the VA doesn't insure, it guarantees a portion of the loan. A massive perk here, VA loans generally do not require any down payment at all. I want to strongly emphasize those operational words for your example, guys. FHA insures the loan while the VA guarantees it. So what happens when a borrower doesn't go with a government-backed loan? Well, they use a conventional loan, meaning it's not insured or guaranteed by a government agency. The absolute magic number to remember here is 80. When a conventional loan exceeds an 80% loan-to-value ratio, which basically means the borrower is putting down less than 20%, the lender is almost always going to require private mortgage insurance, or PMI. Think of this as a safety net. It protects the lender just in case the borrower defaults on the loan. Moving right along to Section 2, repayment and amortization, structuring the loan. Most mortgage loans use a fully amortized schedule, meaning each monthly payment includes both principal and interest. But here's what you really need to understand. While the total monthly payment pretty much stays exactly the same, the mechanics inside that payment shift over time. Early on, you're paying mostly interest, but as the years go by, the interest portion gradually shrinks while the principal portion grows, right up until the loan is completely paid off at the end of the term. Now, some loans are only partially amortized. In these cases, those regular monthly payments actually aren't enough to fully pay off the loan during the stated term. This results in what we call a balloon payment. For example, let's say loan file 124547 is mathematically amortized over a 30-year period, just to keep those monthly payments nice and low. But it legally requires a massive balloon payment after just 10 years. At that 10-year mark, the borrower either has to pay the entire remaining balance out of pocket or refinance the whole thing. Beyond just how the principal is paid down, the interest rates themselves can vary too. With a fixed-rate mortgage, the interest rate stays constant throughout the entire life of the loan. You just set it and forget it. Conversely, with an adjustable-rate mortgage, or ARM, the interest rate can increase or decrease over time. Now, it doesn't just fluctuate randomly. It's tied to a very specific index, clearly outlined in the loan documents. If that index changes, the borrower's interest rate and therefore their payment amount changes right along with it. All right, Section 3, monetary policy, the macro forces. Let's zoom out from the individual borrower for a second. To truly grasp financing, you've got to understand the invisible hands guiding the whole economy. The Federal Reserve System, or just the Fed, has immense influence over interest rates and the overall availability of money. Oh, and for those following along in the course, your verification code is 569887. Anyway, getting back to the Fed, they manage the money supply using 3 primary tools. Number 1, setting reserve requirements, which dictates exactly how much cash banks literally must keep on hand. Number 2, setting the discount rate, which is the rate banks themselves pay to borrow funds. And number 3, conducting open market operations, which just means buying and selling government securities. These 3 actions directly turn the dial on the amount of money flowing in the marketplace, which cascades down and eventually dictates the interest rates your buyers will be seeing. Section 4, primary and secondary markets, the flow of money. So, with the macroeconomic environment set by the Fed, how does the cash actually flow between institutions? Well, the primary mortgage market is the front line. This is where consumers go to get their loans directly. When your client walks into a local bank, a savings association, a mortgage broker, or even a life insurance company to get a loan for their new house, they are interacting directly with the primary mortgage market. But what happens after that local bank makes the loan? I mean, they rarely just hold on to it forever. Once loans are made, many primary lenders sell those loans off into the organized secondary mortgage market. This includes major players you've probably heard of like Fannie Mae, Ginnie Mae, and Freddie Mac. By purchasing these existing loans, these secondary organizations provide immediate liquidity to the primary lenders. They effectively refill the local bank's cash reserves, allowing that bank to turn right around and make brand new loans to the next homebuyer who walks through the door.
Let's move to our final topic. Section 5. Federal Mortgage Laws, Guardrails of the System.
We've seen how loans are structured and how the money flows, but trust me, none of this operates like the Wild West. There are strict federal laws that keep this financial system safe for consumers, and you absolutely must know the difference between these two major ones for your exam. First, the Real Estate Settlement Procedures Act, or RESPA. This applies to most residential mortgages and focuses heavily on the settlement process itself. It requires lenders to provide a standardized loan estimate, and it strictly, unequivocally prohibits kickbacks and referral fees for services not actually performed. Now, contrast that with the Truth in Lending Act, implemented through Regulation Z, or TILA. TILA is all about helping consumers understand the true cost of borrowing money. Under TILA, lenders must clearly disclose the annual percentage rate, or APR, which includes not just the interest, but other financing costs like prepaid interest and discount points. Regulation Z also sets very specific rules regarding mortgage advertising and the use of triggering terms. So, quick recap. RESPA stops kickbacks, while TILA reveals the true cost and sets advertising rules. As we wrap up this explainer on Chapter 13, let's just look back at what we've covered. We tackled the major loan types, the mechanics of amortization, the macro forces of the Fed, the flow of money through the markets, and the federal laws that govern it all. Mastering this foundation is going to make you an incredibly valuable resource. So, which financing path will your future clients take? Understanding this material ensures you'll be ready to guide them no matter which route they choose. Keep studying, keep learning, and I'll catch you in the next explainer.